Paul, good morning. Thanks a lot for joining us. Yes, we've seen some signs of correction in equities. Emerging market equities also seeing a bit of a correction. The MSCI Emerging Market Index down about 3 to 4% from the recent highs. Your thoughts on whether this is start of a bigger correction?
Yes, good morning. Thanks for having me. So I think really the two overhanging issues here is the uncertainty over Brexit. And there's a number of events this week that will either lead to a no-deal Brexit or quite possibly a shifting of the deadline for Brexit away from sort of the more immediate sort of March 29 till perhaps later this year or early next year. So that will be worked through this week, and that has been hanging over the markets. There's also some uncertainty regarding the deal between China and the United States on trade, and I think one of the issues that's prominent there is about mutual compliance on whatever deal is actually struck. So these two factors have led to an increase in risk premia. They have probably also been behind the US dollar being a little bit stronger, which has hit some emerging markets like Korea more than others. We have actually sort of been positioned much more heavily in ASEAN and India, which have held up much better than in North Asia, which we're underweight. But no, we don't necessarily think, unless we get some extremely poor news out of either Brexit or the trade talks, which we're not expecting, then I think we're still in the middle of this first half emerging markets rally.
Okay, Brexit so far was not very material to emerging markets, we thought. What about the global growth numbers? I mean, the pathetic jobs data of 20,000 coming on the back of ECB cutting its growth forecast, a terrible Chinese trade data. Is there a global growth story that's beginning to look much worse? And does that have any bearing for equities?
Right, so address two of those issues there. First of all, as far as global growth is concerned, as I've mentioned on your program previously, we are actually see a recession in the United States by the middle of next year to maybe sort of Q3 or thereabouts. The developed world in particular slowing down prominently between now and that particular point in time. So our view is that the tax cut effect capture is in 2018 and 2019. So we still have orderly growth in 2019, and our view is that 2020 is when that sort of becomes a little bit more sharp. However, in that context, it's important to note that the Fed and other central banks are easing their policy from their previously sort of tight position. Now, this easier credit in the context of still respectable but sort of moderate growth is the fuel, in our opinion, for this sort of near-term rally. Now, we made this call late November of last year, and it's worked out quite well. We're seeing a bit of a correction here at the moment, and we expect that to continue until the markets start to focus on 2020. Now, our view is that it's probably another quarter or so away. So that's the first point. The second point is regarding Brexit. The link between Brexit and emerging markets is via the dollar. So if there was a disorderly Brexit or a no-deal Brexit that led to a European growth shock, the risk there is that you have a flight to the US dollar, which then undermines emerging markets generically. So the link there is actually quite clear.
Okay. Paul, hi, good morning. Now coming to India, you briefly mentioned that the Indian markets have held up much better than the others. We're heading into election time now. In just about a month from now, the national elections will begin. And, with the border tensions being diffused, the expectation is that the current government will come back to power. Do you see a pre-election rally? And as a foreign investor, how do you approach this situation?
So I guess as I've mentioned over the past few months, India has been our biggest overweight. and some of our funding markets, our underweights like Korea, for example, have pulled back dramatically, as are some of our underweights such as Taiwan and Korea, which are much more geared into the global trade cycle. India's growth profile is not, and this is really sort of the key feature about Indian growth is that one, the Indian economy is going to outgrow China. Number two, earnings growth, forecast consensus here is 20% plus, and that growth is not correlated with the global trade cycle, which is actually very, very important. So we stay overweight. It's our biggest overweight. We're about 14% versus benchmark of around 10 for MSCI Asia ex Japan. So that hasn't changed. So we're positioned already, sort of being quite heavily overweight. And yes, I think in terms of looking at fresh money from a global asset allocation perspective, India should be front and center.
Okay. Well, thank you very much, Paul, for joining us with that perspective. So quite clearly, it's India not going to be affected. I mean, that's something even I would think that Indian earnings story not really affected by the global slowdown as much as most of the other leading equity markets.
Absolutely not bad. I mean, foreign investors are predicting a 20% earnings growth for India. So that's some good news.